And Faoud says, I'm liking lately ETFs like GDX, that's the gold. XLE is the energy. SPLG, if I want to implement married put with an ETF, is there any difference compared to a stock? Yes, there is. In a sense, there is absolutely, Faoud. Let's talk about that briefly. Now that I've gone through my rough little discussion of playing around with a fake kind of pair strategy there, double dipping in retail, and there's other ones. Almost every ETF that exists now has an inverse, so you can play that around earnings too. If you start to see oil and gas having less than profitable earnings, you've got the OIH or the other oil ETF, and you've got an inverse for those too. So you can play bullish on the inverse and bearish on the regular if you want to. If you start seeing some of the oil and gas ones, the first two start having bad earnings. Okay, now let's go to the married put search. And of course, here's the default criteria that we use. 90 to 95% of the positions I mentioned that are in the Fusion portfolio at Radioactive Trading come directly from this list. Some of the ones during the coaching session I was discussing, I was looking at Pure Storage as one. What I'm looking for here is pretty close to what's happened. It's channeling. It moved up a little bit. I'm looking to see sort of this MACD bottom and maybe even have a slight crossover in the next few days. We've had two Bollinger Band breakouts in the last 30 days on this one. And it has had the movement and it's pulled back, but I'm expecting some more upside potentially in that. That's one of my ones. On holding, wasn't too happy with the chart itself, but it's one I was considering. I can't remember if the third one was Datadog or if it was Dynamex. Oh, Datadog, yeah, it's looking really close there with sort of a channeling aspect. Yeah, I know it's near a high. Everyone always mentions that, but it's got maybe another 21% to run to its recent high in the last 52 weeks, and we've got this channeling here, and it's sort of had that MACD lower cross, but it's sort of bottomed here, looking for something, looking for some kind of impetus, might have earnings coming up soon. When we look for the married put, you can see our default criteria here. We want to be at least 150 days out for the insurance food. I know you know that. Risk between 3.5% to 9.5%. I might change that to be less than 8% to match my criteria. Manage bid-ask spread, looking for a certain average stock volume, historical volatility of greater than 0.25, and stock price greater than the SMA 50. And a price range between 9 and 200, so on and so forth. Now, we're also using a specific list that we want to see. I'm going to go ahead and take that list out. And instead of looking for that preferred list, we're just going to look at the default ETFs, indexes and ETFs, my apologies. And for the moment, Faoud, I'm going to remove our inverse ETFs and leveraged. I just want standard ETFs, as you mentioned, GDX, XLE, SPLG. Now let me go ahead and submit that search. I left all the option criteria the same as far as what I want for the range in the money, structure of the married put, risk less than 8%. Nothing matches my criteria. Well, we know we don't have certain things such as an earnings per share growth. That shouldn't be filtering it out anyway. It should just be NA, but let's go ahead and take that out. Yeah, I want stocks to be trading above the SMA 50. It doesn't matter to me. I still want a 300,000 average stock volume. That's measured in thousands. Let's go run that. And there we go. Now you've got some in here. We only got 17. You've got XOP, oil and gas. That was the other one I was thinking of. OIH, XOP, I'm sorry. The ARCs, meh. Not really fond of those. URA, Global Uranium, and IZ. Let's go to page 2. ARC-F and IAT, Dow Jones Regional Banks ETF. That might be one to consider. Now I'd probably stick with the SPY one, as I mentioned, sort of that earnings play. Where's your GDX? Where's your SPY? Where's your XLE? Now, you probably already know. I glossed over it. Those ETFs are in the 0.15, 0.18, 0.2 range of 50-day volatility. I have to take this restriction out because they won't have that. The reason why in a married put we look for that stock volatility, the 50-day historical volatility of at least 0.25, is we want to see some movement on the stock. Yes, sometimes I do a low volatility security when market conditions, as you mentioned, are uncertain. My touchstone is I might go back to Johnson & Johnson, Mondelez, Old Kraft Heinz, dividend, stalwart paying stocks that I know have lower volatility, but I'm going to have a low risk. I'm going to be a year out in time. I'm going to withstand what's going on in current uncertain market conditions, probably have a chance to do one or two income methods, sell a call, or maybe even manage the put while collecting the dividend without having a lot of fluctuation in uncertain markets. IBM, slow and go. But that only usually represents 20% of my total married put portfolio because it's slower growth. The income methods do not come as often unless you look further out in time, 45 days, 60 days, maybe 70 days, to get a good percentage income against your cost basis of the total married put position. That's the trade-off with lower volatility stocks as a married put and lower volatility ETFs followed. You are going to have, there it is. There's your SPLG. There's my XRT, for example. Other ones here aren't on the first page. But SPLG, 51.56, right at the money, 52 strike put for 252 days out, but only a 3.8% risk. Applied volatility is at 0.1607, which to me infers the historical volatility is probably at 0.15 or lower. The other ones are probably here too. I can just go to the fundamentals to do a quick scan. We saw SPLG there. We can see XLE. I didn't think it was on the first page. Let's see if it's in our list. There's that one. Right at the money, 81 strike for only a 5.6% risk for 161 days. And as always, of course, you could go to that search by symbol view to see the other strikes against the security for that month, or I could go further out in time if I want to go to March even, 252 days. Let's go ahead and take a look there. So going up to the 82 strike is a 6.3. The 83 is only a 5.7. That's equivalent to what the 81 was for December. That was that 160 days out in time. So again, the volatility here a little bit higher, 0.22. But the reason why you didn't see a lot of those initially when I took out the stock list and just screened against the ETFs and removed the inverse and leveraged ETFs is you also have to take out that volatility. You're expecting less movement. Income method adjustments might be fewer and farther between to come by because the movement is much slower and much stable. You have low risk. You have protection in place. Most of these are going to be paying a dividend as well, followed longer term, which is what sounds like you're planning on through an earnings season or things of that nature. But again, you don't have as much opportunity to the income methods as our experience. Even with GDX, XLE, and SPLG, which have a better volatility. SPLG actually looked really low, by the way, at 0.16. But that's the exact same thing we'd expect with SPY. Speaking of which, is SPY here? Just take a look at its implied volatility. It's not the stock volatility, but let's just take a look at the implied volatility. It might be down to 0.08. Ooh. It's not even in there. Oh, this risk might be too high. I'm sorry, Food. This is another thing you might want to consider. Lowering that lower limit of 3.5%. And the reason that's there is there is such thing as too low of a risk. If I'm too deep in the money and have too low of a risk, my expectancy of profit is too low. Wow. Did I take out the price range? Thank you. No, I did not. Brilliant. Brilliant. There we go. So 438, the at the money is only a 3% risk for the December 161 days out in time. Okay, so if I put that back up to 3.5, we'd see a further out, slightly more in the money one, I believe. There we go, 440 at 5.7. That's more reasonable. That's, wow, 2024. Okay. But yeah, I mean, we're right at the current stock price, so income methods could be approached right away. But again, that's where I was looking. The implied volatility is at 0.18. The actual 50-day volatility for SPY, I should just add the column in there, but 50-day is 0.12. Right? That's numbers we expect to see, and we have seen, but we haven't seen in a long time. When the volatility was at 23, 24, 31, 33, now we're back down to 15, 14, and 13s, which we haven't seen consistently in a long time. So that's the trade-off forward. The market knows what you know. Those ETFs that we were discussing are less risky, have less movement, are less volatile. Hey, one benefit, therefore, to married put structure, they're going to have lower risk, which also comparatively, and take a $55 stock with a 56 strike call on a tech stock. I'm sorry, 56 strike put for December on a tech stock. You might be looking at a 7.5%, 8% risk. Here it's only 5%. Buying a stock like AMD right now, which is at 113, 115, but buying it at 1.7 and buying a December 110 put, you're looking at a risk of 9 or 10%, not 3.7 compared to the US Tech ETF by IYW, my apologies, and so forth. And there's your SPLG. I remember food. How did I do this? We just went to the lists, changed it to include indexes and ETFs, then removed the inverse and leveraged ETFs, took out the stock price limit, of course, and for the technicals, take out the volatility. And we also took out the percent earnings per share growth as well from the initial default. That's all you had to do. And then you've got sort of the structures you want, and then you can continue to toggle from there. But again, the key here, what is the difference? Just as you expect. Lower volatility by itself means lower risk. That by itself means your married put's going to have a lower risk. But that also means the call premiums and premiums for income methods, the different riskless spread trades discussed in the blueprint, are also going to be lower. You might only be generating 0.2, 0.4, or 0.5%, as opposed to where, hey, I only have a 3% risk, or 3.8% risk. If I generate 1.5% on SPLG every 14, 20 to 30 days, like I can with a standard covered call or cash secured naked put, I'll have that paid off in no time. Now, the problem is that the at-the-money options, and we only have standard? Yeah, we only have standard expiration. The at-the-money calls, 1 month out, we're looking at a time premium of only 0.4, 0.5%. August going 42 days out, and we're looking at, the 53 at 0.7, the 52 at 1.5. So you're maybe not even close to half of knocking down that value in those cases. I'm sorry, it's 1.1. So there's a third of that, but going 42 days out, you have 160 days to go. That's the trade-off. Less risk, less market volatility, but the market knows that. So by definition, you're going to have a lower extrinsic value cost. You're going to have a lower risk, but you're also going to see lower premiums with these kind of lower volatile stocks and ETFs specifically. Is it less volatile than going through the earnings seasons and having surprises of 7 to 8% declines, 12 to 15% declines, sudden things in the banking industry like my Schwab position at 31% decline, but I only took a 4% loss, 5% loss, my apologies, absolutely. But then the profits to the upside are going to be muted. The income that you can generate to the upside or with income methods is going to be muted because of the low volatility. It goes hand in hand. It's going to be a slower growth, slower gain realization, and slower income coming in than that more volatile stock, subtly more volatile stock we look for in the default married put screens of 0.25 volatility. That's the difference with an ETF married put. Standard ETF married put forward compared to a stock, even the three you're talking about, GDX, XLE, and SPLG. And of course, anyone who is curious what we're talking about here, that preferred married put structure with the controlled, limited risk and unlimited upside profit to start, with the availability to do 12 different income methods. If the stock moves up as we initially expected, if the stock stagnates, it isn't quite showing us the movement that we want, or if the stock falls against our expectations, there are income methods for each discussion, and the full course that describes the proper full structure, how to implement this, and the use of the 12 different income methods, of course, is in the blueprint. It's an all-electronic online course, mostly text online, not PDF version, but hosted by our third-party portal, learn.powerup.com, and some videos in there as well. But that is the full course on the married put structure, setup, chapters on all of the 12 income methods to use in different market conditions once you're in the married put, management of those income methods once you're in them, and full chapters on exiting the married put position, when to consider exiting or adjusting the position if one of the income methods doesn't suit you. Full appendix on different trades, historical trades, and much, much more. So then we talk about the married put. That's what we're talking about. Our full education course, the blueprint, and of course at radioactivetrading.com. The blueprint's also there, but this is where Ernie and I post our trades following the rules in the blueprint, those married put positions, the 4 that I'm in that I mentioned earlier in the presentation for NEM, ASO, AMD, and Fortinet. And Ernie's got 7 married put positions, and I'm considering opening 2 more very soon. Likely one of those 3 that I mentioned as far as Pure Storage, the Datadog perhaps, and what was the other D one? The Dynamex one that I didn't see in the list actually, so I might not be considering that. All right, folks, so I hope that answers your question on comparisons of what to expect with a stock married put position following the default criteria we use in Power Options, and 95% of the trades we post in that Fusion portfolio come directly from that default married put search, the radioactive sorted by earnings per share growth. But to change this up a little bit, keep the proper structure, but look just for ETFs, I'd suggest maybe lowering the maximum risk down to 2% or so. Some of them are going to have that lower risk. Change the list field to screen specifically just against indexes and ETFs. That's one of the programmed company lists. Let's go ahead and remove the inverse and leveraged ETFs. Take out your earnings per share growth here and the fundamentals. Then take out the volatility limitation in the technicals. I'd leave that 300,000 average stock volume there to see more active ETFs, the ones you're looking for in that range. Oh, more than 600 results. Oh, I lowered this down to 8, I think. Not that that matters too much. That's odd. That is so odd. I don't think, let me put it back to 3.5, but I don't think I changed anything else that would have taken away what we had there. Okay, there we go. 98 results. That's more along the lines we're looking for. There's your SPLG, as I mentioned, by XRT. All right, so leave the risk at 3.5 to start with, then you can lower it later. How about we go with that one?